Hey, everybody, welcome to today's webinar. Now let's begin. This is on construction one-time close. I just think this is a great program. Meet Jim Perkins, a seasoned mortgage banking professional with over 30 years of experience with New American. He's now with New American Funding. Jim isn't just highly experienced and respected in the real estate financing world. He's also an exceptional trainer, unraveling the intricacies and complexities of real estate loans and credit. His training ability empowers clients to navigate the mortgage process confidently, ensuring they secure the best fit mortgage for their needs. I'm sure he doesn't mind that I say the next thing. I think Jim is probably, out of our whole group, the best one to handle people that have some credit blemishes that they need to work on. Maybe they can't buy for a couple of months, 6 months, whatever. He doesn't drop the ball. And what I see with people is they kind of give them a laundry list and send them on their way. Um, Jim will get those people ready for you. And I just want to point that out because even as an agent in the old days when I used to, be an active agent, I didn't see too many people that actually stuck with that. And most people send them off somewhere or they just hope that they come back. Um, Jim is a valued instructor at Cindy Bishop Worldwide, where agents and consumers consistently rate him highly, as reflected in numerous positive feedback surveys. Welcome, Jim, and welcome everybody today. And if I don't see you guys before Thanksgiving, happy Thanksgiving or whatever you celebrate.
Thank you.
Welcome.
Okay. Thanks, Cindy. Appreciate the introduction. And thanks, everybody, for coming to the class this morning. So what we're seeing is construction one-time close. But what we're seeing is, Cindy was talking about before about reverse mortgages and the different types of programs. Because the inventory is so low, we're seeing a lot of different programs that are coming to the forefront. And one construction one-time close, we didn't see this used a lot, but in the last 6 months, I've probably done like say 3 or 4 of these. So just think of it as another arrow in your quiver that you can use to help somebody move forward and make a purchase, because they don't have to always buy from a builder. They can, get the land, find where they want to be, and build the house that they want. So, and the other want to shout out to, Cindy is always bringing us fantastic programs. She's always thinking of new ideas to help educate the realtors to make you guys more valuable to your clients and the consumer out there. So, thanks a lot, Cindy, for continuing to put these programs together. So
You're
today,
awfully special to say that because that's exactly what I do.
well, exactly. And I know you work really, really hard. You probably don't get a lot of thanks for that, but you work tremendously hard in order to make sure that, one, the instructors are doing a great job, but also that the courses are something that will help the realtors, provide useful benefits to their clients. So,
True. Thank you.
absolutely. So, course objectives. So, we want to, as we go through this, we only got an hour, so we're going to move through it relatively quickly. There's not a lot, but what we'd like to kind of give you is a broad brush of how this program could work, and maybe kind of generate some ideas for you that might help you generate some more business. So we want to, as we go through here, we're going to try to understand the use and benefit of the construction one-time close. We're going to talk about eligibility of the borrowers, who's eligible for the types of programs, the type of properties that are eligible. We're going to talk about the underwriting guidelines, the lender's approvals and the process that you got to go through, and then the buyer and the contractor responsibilities, because it's different than your standard loan program. So, so what is a construction one-time close? So a number of years ago, what you used to have when somebody had a piece of land that they wanted to build on, or they were going to purchase and build on it, they did two closes. Basically, you got a construction loan, and then what you would do is once the construction was complete, then you would go out and get a loan, a permanent loan to pay off the construction loan. So what the one-time close does, it kind of combines both of those loan programs together. So you get the construction loan, and then at the end of the process, when the construction's complete and it's all set and ready to move in, you've gotten all your inspections, basically the residential use permit, everything's ready to go. then they do a modification on the loan. And then what that does is allows, it actually saves the buyer or the consumer a little bit of cost as far as closing costs is concerned, but it structures them, it gets them lined up for the permanent loan at the very beginning of the process, as opposed to waiting to see what might be out there. And then also too, they have programs that you can actually lock it in for a certain time frame, I think up to a year, where you can lock in that loan. And I know the one we have, you can lock it in for up to a year, and then you have a float down. So, in this market today, very strange market, as Cindy is saying, there's a lot of changes that are happening. The Fed, dropped the rates 0.5% about a month and a half ago, and then just dropped it last week, another quarter. But what you're seeing is normally when the Fed does that, you're seeing interest rates would move down. But what we've seen is interest rates are actually moving up because the markets are doing good, like the Dow Jones, Standard and Poor's are all moving in a positive direction. But there's a concern out there that inflation is going to continue. And because of that, you're seeing interest rates move up again. And it's totally opposite than what you would normally think. So with this one-time close, if the person does have the opportunity to lock in, it would probably make sense to do that. And like I said, comparing it to the two-time close, you wouldn't be able to lock in the loan program until everything was complete. Then you would go out and look for a loan to pay off the construction loan. And it kind of takes away, depending on the circumstances, having to get something lined up. So you know that at least you're all set and ready to go once the construction is completed. So the construction loan, so the cost to purchase the land, if not already owned. So this can work two ways. One is the person say, hey, I really like this lot. I think I want to buy the lot and then I want to build on it. So this would be a process that the person is looking to buy the lot and do the construction or building the home relatively quickly. It's not somewhere where somebody would buy a lot and then say, oh, I think we're going to build on it when we retire, maybe 5 or 10 years down the road. This wouldn't be the type of program that they would go with that. Now, they could buy the lot. We've had people that'll buy the lot and then hold on to it. And then when they get ready to a situation where they want to make it their primary residence or a secondary home, then what they would do is go through the construction process. And again, makes sense to do the one-time close on that. So they can include the cost to purchase the land if they don't already own it. And then that allows them to, like say, have the property already lined up. And so it gives them a little bit more flexibility if they do have the property. The one thing you want to remember is that the construction loan process, they're going to go through the process and get the construction loan approved. And basically, when they get that approved, depending on the program and the circumstances, they're basically approved for the modification at the end. But it is important that they, once the construction closes, then if to say they're purchasing the land doing that, then the seller is basically out of the picture. Then it's their house or their land, and they're working on the construction loan. So it would also include, architectural drawings, contractors' fees, permits, contingencies. When they say contingencies, what they're looking at or talking about is that, sometimes when people are building or even renovating a home, they'll say, what, we really, I think we would like a closet here, or, if we could put a door in there. So they build in a certain amount of contingencies in there, cost for contingencies, in order to be able to adjust for those or make those adjustments as they go through the process of the construction. So the loan amount is going to be based on what the property appraises for as completed. So based on the plans and specs. So somebody would get plans and specs or already have plans and specs for what they want to build. So if you have a person that is looking to build a home, they don't have to have the land all set. We've had people that will have plans and specs, made up, and they'll hold them for a year or 2 years or whenever they're ready to go, and then say, okay, this is the land I wanted to purchase, and then these are the plans and specs. So they'll already have those moved in. The thing to remember is that the construction loan is not going to close. It's not going to be like a 21-day or a 30-day close because there's a lot more that goes on with the construction loan than your standard loan. So it's going to be, the time frame is going to be a little bit longer. I'd say probably you're talking a minimum of probably 60 days. You might be able to get it down to 45 days, but you want to give yourself a little bit of flexibility in there. So but with the loan amount though being based on what the property will be, the appraiser is going to take those plans and specs. He's going to do the appraisal based on what the plans and specs come out to be. So there can't be like major changes, but they can make, like I say, some contingencies as far as when they're doing a construction loan. But that appraiser is going to, based on those plans and specs and based on the property and the location, he's going to do an appraisal, and he's going to look for different types of properties or similar types of properties in that area, depending on where they're buying, in order to get the appraisal done. So it's the type of thing that the plans and specs are important to have. And if the person doesn't have plans and specs and is going to do that, let's say after they purchase the land, then the construction loan, the first portion of it, as far as the closing, is going to take a little bit longer on that because everything's going to be based on those plans and specs. So the one-time close, the eligible borrowers that you're looking at, so this is pretty standard as far as most of your loan programs are concerned. So your standard, Fannie Mae, Freddie Mac, your VA, FHA, all the borrowers that would be eligible for those type of programs are going to be eligible for your one-time close. So U.S. citizens, permanent resident aliens, and then non-permanent resident aliens. And they're looking at the different what type of visas are going to be acceptable for if you have somebody who's a non-permanent resident alien. So mainly it's going to be, like I said, the standard that you would be going by if they would say just getting a standard conventional loan and just purchasing a regular house, or an FHA type of loan program on that. So the one-time close, ineligible borrowers, so non-occupant co-borrowers. So an investor, which, and I found out recently that there's not a lot of programs out there that will allow investors to do a construction loan. I've had a couple where I was helping somebody as far as giving them some guidance and direction in order to be able to do an investor construction loan. And they were working with a builder, and the builder says, oh yeah, we've got 3 or 4 lenders that we can use. Turns out that all of the lenders would not do an investor program as far as a construction loan was concerned. So that's going to make it a little bit tougher if you have somebody that is an investor. So you'd really want to kind of dig into that to see what type of financing might be available for them, because it looks like or sounds like it's not going to be available under your standard program. So it might be something that they might have to go to a bank and get a bank, like say, that's in the area that is familiar with that area and those that property that they're looking to purchase on that. So the an owner builder. So the owner, in other words, if the builder's the owner, they wouldn't allow them to use the construction or the one-time close program. It's usually they want to hire a specific contractor. And you see this a lot of times with the renovation loans. They won't or they don't want to see the person that is getting the loan is the person that is actually going to be doing the work on the property. They want somebody that is going to be like a builder or a contractor that is going to be able to do the work on it. So the type of trust, so the living trust, they're having issues or challenges with the trust, so they won't allow those. And then borrowers with a foreign address and currently not living in the United States. So and basically it's pretty much going to follow, like I say, all your standard guidelines. But the important thing to remember is this one-time close, it does change from lender to lender. So if you find one that is not working, then I would say, look around, shop around. Feel free to give me a call, and I can help direct you if we couldn't handle it as far as a direction to go, because the situations can become unusual or unique, and it can develop very quickly. And just to give you, so the loan amounts that you're looking at is conventional right now. as the one unit, and then the high cost. This is a high cost area. So in Northern Virginia, you'd be looking at the high cost loan amounts, and then your FHA and the VA. Now the VA, depending on, I just did one about 3 months ago where the people were buying down in the Charlottesville area, and at the time, when they were looking to go through the process, the one unit limit was like the 766,000. And so they were trying to find one, and they were having trouble finding, this was a VA, one that would go over that amount because their property basically appraised out to 1.1 million. And they were going to have to pay 25% of the difference between the 766 and the 1.1 million. So they were going to have to bring a considerable amount to the table in order to do the close. Well, we would do up to the high cost, and actually they'll make exceptions to go above that. But we were able to do the one-time close on the VA, give them the $1.1 million. And when they went to closing, they came to closing with like $325. So it was very advantageous for them. So the thing is, the one-time close, it's not like, say, a standard program that you have, like, say, okay, this is FHA and it's standard. It's going to change a little bit from lender to lender. So depending on the circumstances that you have, if you have something that might be a little bit unique or unusual, I would say just because one lender says no, we can't do that, don't be discouraged. I would say look around, maybe try to find some other lenders that might be able to handle that situation, especially when you're talking about the loan amounts. Now the FHA and the VA, they're depending on the area that you're looking at, but the high cost area, because we're in a high cost area, we can go up to the 1,449,825 as far as this particular area. But now the VA is much more flexible, because if the person doing the VA has full eligibility, then they're going to a lot of times be able to go over that amount, even though they might not be in a high cost area. So I know some lenders will stop them at the 802, but some will allow us to go higher than that and even above the high cost limit area. The FHA is going to depend on the area that they're in, because FHA structures it a little bit different based on the county that the person's in. So, and it says here the minimum loan amount is 100,000. I don't think you'd be able to find a construction loan that'll go less than 100,000, but it doesn't automatically mean that it's not available on that. So, like I said, it'll change from lender to lender. So it's something that you do want to, if you have somebody in that situation, you might want to check around with different lenders to see what might be available. So generally speaking, your one-time close loans, so it's 30-year fixed, 25, 20, 15, and 10-year fixed loans. Now, I've had people that in just general loan programs that, they're thinking either 30 or 15 years. Sometimes I've done a couple where people will do 10 years, but if they come to me and ask me for a recommendation, I always tell people, go with the 30-year, and then say if you wanted to pay it off in 15 years, just amortize the loan like it's a 15-year. Or if you wanted to pay it off in 10 years, just amortize it like it's 10 years. Or if you wanted to pay it off in like say 7 years, or whatever the term or time frame you wanted to pay it off, you could amortize it like that and then make those payments. And then like say if you amortize it on a 15-year, and then at the end of the 15 years, the loan would be paid off. It would save you interest because you're prepaying it. So they would be reducing the amount of interest that you would pay. But to me, the biggest advantage, and it becomes a personal decision based on the client that you're working with, but the biggest advantage of this, say if you had somebody that was going with, we'll say a 10-year loan or a 15-year fixed rate, and they're making their payments on time, paying down the loan, they're really happy with it. And then say 5 years down the road, something happens and they're having trouble making that much higher payment. And they're saying, well, I really can't do that. I'm having challenges to do that. They have to go to the lending institution. It could be, if it's a servicer, then the servicer is going to have to contact, say, Fannie Mae or Freddie Mac or FHA and see if they can work something out. A lot of times they're just going to start talking to you about, hey, if you don't make your payments, they'll start talking to you about foreclosure. And a lot of times they won't even take a partial payment. Say, hey, I just need a partial payment for 6 months or 8 months, and then I think I can get back on track. But if a person did, like say, a 30-year loan and then amortized it, like say it was 10 years, over a 10-year period, and then 5 years down the road, they had some challenges, they weren't able to make that full payment, it is then their decision to go back to making that 30-year payment. So they don't have to go through any type of approval process or modification. They just say, hey, it's a 30-year loan. I've been prepaying it. There was no prepayment penalty, but now I'm going to go back to the 30-year payment. So that would give them a lot more flexibility, especially when you think about all the changes that can happen. And changes happen so quickly in today's market where, everything is electronic. So interest rates can move up and down very quickly. And this would give the individual borrower a lot more flexibility. And it basically becomes their decision. So, and I think that makes it very advantageous. But again, it's going to be up to their decision. It's not something that they have to do, but just a different perspective. So the occupancy, primary residence, and that's pretty much all products, and secondary homes, that is only on your conventional loans. And that's just because the FHA doesn't do second homes or investors, although they used to years ago. And then the VA is only for primary residence on that. So then the maximum LTVs that you're looking at, so your conventional, they'll go up to 95% on conventional loan program on it. There people were doing, and that's as a primary residence. If they were doing as a second home, then it would be 90%. And then and on the conventional, I would tell people to make sure, because these percentages, allow them to put 5% down on an owner occupied and 10% down on a second home. Over the last several years, there's been some changes as far as second homes. So it's become much more restrictive, I guess, of second homes, because the government agencies, mainly Fannie and Freddie, have indicated that, hey, we're not in the market to provide people with second homes. We're in the market to provide people with, primary residences. And so the changes they made on second homes align them a lot closer to what, especially with the interest rate and the cost of what an investment property would be. So if you have a person that's looking to do a second home, you just want to dig into that a little bit and find out exactly how they're going to structure that, and also what the down payment's going to be. Now, if you have a person that has a lot of money to put down, then it's not going to be a concern. It's just if they're doing the minimum down as far as the 10% on the second home. So FHA at 96.5%, the maximum LTV. And what that is your standard FHA loan. They'll, 3.5% down is basically what the standard FHA will allow. And it's the same thing here under the one-time close construction loan. And then your USDA and also your VA, both require it to be owner occupied or principal residence, and both of them will go up to 100% of the value on that. In this area, we don't see many USDAs. Those are basically, as you go further out, more rural, as opposed to, the areas that we live in, suburban areas. Okay, so your maximum interested party contribution. So conventional loans, your owner occupied and second home. So above 90%, so 90.01, it's 3%. So that would be, the 5% down is 3%. And if they put anywhere between 5 and 10% down, it's still going to be 3%. Now, once they hit the 10% down, then it jumps up to 6%. And then 75 or 25% down and below, it goes to 9%. Now, when they're talking about interested party contributions, this most of the time people are thinking, well, the seller, we're going to get the seller to pay. But if there's anybody else associated with the transaction, so if they were working with the builder and the builder said, hey, we'll kick in some, or as a real estate agent, you decided, hey, I'm going to compensate them and maybe give them part of the commission. Those are all considered when they're doing the calculation for interested party contributions. So those are the things that you want to be aware of because you don't want to structure a deal and then end up having to leave some of that money on the table, not to the advantage of your borrower. So the FHA, and this is like standard FHA. FHA allows 6% down, even with the 3.5% down payment. Now, for a number of years, Congress has talked about changing that 6% and making it more standard with the conventional loan programs. But there's always a lot of talk about it, but I've never seen anything that looks like they're going to be moving forward with that. So as far as the percentage down, the FHA is going to be the interested party up to 6%. And they can use that as long as they're putting 3.5% as far as the down payment. That 6% can be used for, they can pay points on it. They can pay closing costs, pretty much anything. There's no restriction. Now, the VA, there's 4% of the loan amounts, not the sales price, but it does not include your normal discount points, which they will allow up to 2%. But it doesn't, that 4% does not also include the buyer's closing cost. And so the standard closing cost is not included in that 4%. So the seller could actually pay 4% and then also pay the closing costs. Now, when you say closing costs, they don't include some of the prepaids, like the prepaid taxes and the prepaid hazard insurance and prepaid interest. But all the other closing costs, they could pay that plus pay 4% and then pay an additional, actually 2% or 2 points in order to get the veteran, to make it attractive for the veteran. So this is pretty much standard as far as the standard the VA loan program. This would be the same guidelines that you have if somebody was using the VA to make a normal or regular purchase on that, like a house is already there. And the USDA, same thing, as 100% and below will do 6%, and they just follow their standard guidelines on that. So a lot of flexibility on that, and a lot of times these programs just basically mirror what you're looking at as far as your normal standard programs if somebody was buying and not doing the construction loan. So eligible property types. So you're looking at single family, detached residences, the modular homes, including prefab, if approved by the county zoning, and barn dominiums included. So when you say if approved by the county, so one of the ones actually was the one that I closed several months ago, and down in the Charlottesville area. On part of their plans and specs, they were working with the builder, and the builder was telling them that they could do 3D printing on the walls. And because they use that term 3D printing, it raised all kind of red flags on it. And basically, they call like a cinder block, a normal cinder block, they call it a CMU, I think, or CUM on it is how they describe it. And I just told them because the 3D printing that they were using in that area was just a larger cinder block instead of being like a foot or a foot and a half long, and then maybe 8 inches or 8 inches wide, or what they call 12 inches wide, or 8 or 16 cinder block. These were much longer. It might be like 8 feet long, but they called it 3D because it was printed at a computer at the warehouse. They let it cure it, and they would bring it to the site. So that 3D. Now, what happened is they had to get VA involved, and basically VA came back and said, "Hey, listen, if the county doesn't have any issue with it, we don't." And the county, they had already done several in the county that had that type of building on it, the 3D printing. So they were allowed to move forward with it without any issue. Now, but you can always switch it back to your standard building process. But just because they had that 3D printing in there, if they said if there was custom CMUs, then I don't think there would have been any issue. So we had a long discussion about that. And then barn dominiums. Barn dominiums are basically houses that look like barns, but they're also included. The key thing is that in the type of properties that they're looking for is the appraisal. So in order to get the appraiser to do the appraisal, normally they're going to have to find properties that are relatively similar in that vicinity. They have a lot of flexibility, so they can use a little bit different property types, and they can go a little further out as far as distance is concerned, depending on the area. But they need to find something that they can use. So if it's a really unusual property, then they may not be able to get the appraised value that they're looking for in order to do the construction loan. Again, it comes back to the plans and specs and what they are and what they describe that the property is going to be. So they'll do single and double and multi-wide manufactured homes. And these are primary residents. So when they say single and double, multi-wide, they're basically talking about, the type of homes that you would see in what we call a double wide, like a trailer park. But they've actually structured these a little bit better. They're built, they're and put together and then put onto a foundation. So a little bit better than just like your standard, trailer that you're looking at on that. And then the modular homes, they will allow modular homes too. And those are ones that are built in the factory and then brought to the property and then attached to the foundation. So, and it says complete tear downs of existing dwellings. Foundation must be included for the USDA one-time close loan. So they're basically saying, hey, if the property is just in terrible shape and you just got to tear it down and rebuild it, they're going to allow that. This is one that I would specifically check if you had somebody that is working or looking to do something like that, but specifically check with the lender beforehand to make sure that that type is going to be workable under the program that they're looking at. Because they may say, hey, we don't do this under our construction loan, and maybe we'll do it under a rehab loan. And then it just puts it into a different category. And so it might not be as flexible as what you would see on, like, say, a one-time close, or it might be a little bit more flexible. It just depends on what you're looking at as far as what they're trying to do and what they need to do. If they have to put in, can they hook up to county sewer and water? Do they have to, dig a well and septic, that sort of thing? So those are all the type of things that will be looked at through the construction loan process before the actual construction loan closes. And then that's when they would start the property, when they would start doing the building on the property. So ineligible properties, so co-ops, multi-unit properties, leaseholds, tiny homes, investment properties, and construction in progress. And so some of these, to me, don't make a lot of sense, why they wouldn't do investment properties, but it's pretty standard from what I understand across the industry. Tiny homes, I think that as time goes on, you'll see that these type of homes will be included, just like the modular homes, the single wide and double wides were something that were never included before. And now as time is going on, they've started to include those in a lot of the loan programs. So it makes it a little bit more flexible. And those type of homes are actually cheaper than I just had somebody that was looking at a property down in Smallville, Virginia. And the builder said, hey, if we're doing a manufactured home, like a double wide, and the borrower went down and said, hey, it looked pretty nice, but the total cost to clear the land and get into it was going to be like $160,000, not including the cost of the land. If he wanted to go modular, then they were talking about $260,000. So the modular, I think, is probably a little bit more substantial and is obviously more expensive in order to get the property there. So again, if you have somebody that's looking to do something a little bit unusual, I would just make sure that before they delve into it, as far as, say, purchasing the property beforehand or putting a contract on a property, that they get that all lined up so they know that, hey, they're in good shape. They will be able to move forward with that. So the one-time close credit scores, and again, this is something that I would say would probably change from lender to lender, But so the 680 minimum FICO score on a conventional loan, requalifying required. And what that means is if the credit score, if you had somebody below the 700, you can see the next one says 700 minimum FICO score, no requalifying required if less than 12 months from the loan closing date. So what that means is at that 680, if they're from 680 to 700, that means they're going to have to requalify once they're starting to do the modification. If the person is like, say, 720 above that 700, then once the construction loan is approved and they start the building process, once they go to the final modification of the loan, the permanent loan, then they don't have to go through the requalifying process on that. There'll be certain things that they'll check, probably like employment, just to verify that they're still employed, but they don't have to go through the full requalifying process on that. And then that's an advantage, especially if they have the loan locked in. If they have the loan locked in and then you have that float down, and so it kind of gives them some protection in case you see interest rates spike way up through the time frame of the building, whether it's 6 months, 8 months, or they get into the 12-month time frame. So the FHA and VA will go down to a minimum of 620 on the FICO score, doing the maximum financing. Then if you go below the 620, they're looking at putting at least 10% down. And there's going to be probably a little bit more hoops that they're going to have to jump through. Now, to give you an idea, as far as the credit scores, these can change. We used to see when things were, moving, the inventory wasn't low, and the amount of loan programs or the amount of loans that were being done on a monthly and annual basis, the tremendous amount, you saw that a lot of the credit scores were tight, a lot tighter. So at 620, it was like, hey, if you're below 620, you can't get a loan. And you couldn't get it anywhere. Nobody was offering, or very few people were. Now, with the inventory being as low as it is, and also not a lot of loans being done, they've really dropped down the credit score requirements. They've put a lot of, different hoops that the borrower would have to jump through, but it is something now that is available. So as time goes on, and I would say production picks up, then you'll probably see over time that these credit scores will tighten up. I don't think there's any question that that's definitely going to happen. Okay, so the one-time close eligible cost. So a lot of times when people are building or doing construction loans, the one-time close, they're not really aware of all the costs that are going to be associated with it. So it's important for them to understand what's going to happen through the process. So, and these costs, a lot of the costs, and depending on the loan program, like the one we had with the VA, they allow pretty much everything to be rolled into the loan. And again, remember, it's based on the appraised value of the completed property or completed home. So contingency reserve, and this, remember, we talked about a little bit earlier about the contingencies, but that reserve, a minimum of 10% or 6 months reserve. So what they're doing is adding 10% in there. So any changes that the person might want to make as they're going through the construction process, because a lot of times people will look at the plans and specs and say, hey, yeah, these look great. But then as everything starts to be built, they'll be walking around the property and say, you know what? We really should have, an extra closet in here, or, maybe put another bathroom down here. And so that reserve there allows them, it's already built into the process. So it gives them that flexibility. So they don't have to come out of pocket for that cost if they don't want to. If they want to, they can always come out of pocket for it. But this gives them the flexibility that it's in there. So your permit cost, your consulting fees, if they have consulting fees that they're going through, if they're working with a builder, they might have a home inspection that they go in there, or somebody that they're consulting with as far as the whole process is concerned, to give them an idea of what to expect and what's going to be happening. Then those can be included also. And then inspection and title update. So the title update fees, the title company is going to continue through the process to update the title. make sure there's no additional liens or claims on it. And then inspections, you're going to have inspections throughout the total process. It could be, county inspections or other type of inspections that you might need or have, especially if you're dealing in a place that has like a well or septic. You're going to have inspections to make sure that those things are all working properly. And then architectural and engineering fees. So sometimes you'll need to get some special engineering into the mix in order to get the property the way they actually want it. And then the architectural, those basically your plans and specs. Engineering fees, you may not have those, or most of the time you wouldn't see those unless there was something that you would need. In other words, it says if needed. And then the architectural, as they go through the process, there sometimes they might make some changes and stuff that will fit within that 10%, and then that could be additional architectural fees as far as the plans and specs that they're looking at on that. And so the one-time draw close process. So who does the draw? It basically, the draw requests are submitted by the builder, and those requests, they're going to be looked at by the lender. They're going to say, okay, what is this for? And then they're going to be basing it on their previous draws. They're going to say, okay, the previous draw was to put the foundation in. They're going to say, okay, that's one of the inspections. Okay, is the foundation complete? So they try to put checks and balances in the process so that the builder's just not taking that draw and then, going to Las Vegas with it or something like that. So they want to make sure that there's inspections to make sure that whatever the draw was for has been completed on that. So all draw requests are submitted using the on-site portal. And this has gotten to the point where it's electronic now, where the builder will put it in the request, what the draw is for, how much it is, and what it's for. And then that way, because it's electronic, it goes in there. It can be submitted. The builder's just putting it in once. But when it goes to the lending institution, then that can be hit or viewed by a number of different people through the process. So that's where you'll have teams that are working on these construction loans or the one-time close, where you'll have a number of people looking through the process to make sure that say, okay, yeah, this draw request, we've got the previous inspections in there. Or if they need to get an inspection, then they can go out and say, okay, we need to get an inspection before we can release the next draw on that. So draw requests can be submitted at any time if there is work in place and can be evidenced by a progress inspection. So that's, excuse me, that's what we were just talking about as far as getting the draws. They want to make sure that the process that the previous draws that were requested, that the work that they said was going to be completed with those draws has actually been done. So that progress inspection. And that's part of the fees and the inspection fees that can be added into the cost of the construction. And say the number of draws. So normally there's going to be a limited number of draws, like say 6 draws, 5,000 minimum draw each amount, draw amount for each project. But normally your first draw is going to be somewhere around 10% of the project, depending. But usually it'll take care of if the land has to be cleared and then the foundation poured. A lot of times that first draw will be for that amount, and then the next draw, they'll have that progress inspection to make sure, okay, the property's been cleared, okay, and now the inspection, the foundation's been poured. Okay, yeah, it's okay to move forward with the next draw. So no issue, no problems as far as that's concerned. And then required information. So as the borrower is going through the process, there's a number of, I guess, checks and balances, but also approvals that have to happen. And so this one here it tells you required information. So the builder company name, so the builder name, builder company address. So, and company, contact information, email address. The reason why they're getting all that stuff is because the builder will actually have to go through an approval process. And so when they go through approval process, and this is pretty standard, whatever builder is going to be used to build the home, they're going to go through a particular approval process. Now, a lot of companies, what they'll do is they'll have a third party, and that's all that third party does is they review the information as far as the builder. A lot of times they'll pull a credit on the builder, they'll do background checks on the builder, they'll make sure that there's nothing unusual or suspicious about the builder, to make sure that the money that's being taken in order to build the house is going to be used for that. Now, depending on, like on the VA, if a person is using a VA, that builder has to be approved by the VA in order to be able to build that house using the VA home loan program. And so if a builder is familiar with that, a lot of times they're already approved, they're in the VA system, they'll have a VA number that a VA uses in order to identify the builder. You punch that into the system and it comes up with the builder and that their approval, and so that they're in good shape. If the builder's having issues or something like, say, with the VA, then it would also be listed, or their approval might be suspended. So that's something that as the borrower is looking at different builders, they would want to make sure that the builder's approved for whatever project or whatever loan type that they're going to be using. So like say if it's a VA, the builder has to be approved by the VA. If it's conventional or FHA, not so strict, but they're still going to have to go through the process of doing that. So they're going to be looking at the builder's financial situation also to make sure that the builder is in good shape and not having any issues or concern as far as financing is concerned. So so also some of the required the following information about your project: estimated days to obtain permits and complete all the work, requested number of draws, and provide a copy of the following builder document. So they're trying to get an idea when they say estimated days. Okay, it's going to take 6 months, or we can do it in 3 months. Okay, if you're doing it in 3 months or 4 months, which would be very unusual for a construction loan. Normally, I'd say 6 to 8 months is standard. 12 months, it should be done in 12 months, no issue, unless they're running into some concerns or stuff along those lines. But and so that gives them an idea as far as the loan program, when it's going to close, and what they're going to approve as far as the loan is concerned. So the builder's license, they're going to want to see the builder's license and make sure that there's no issues or concerns as far as the builder is concerned. General liability insurance, that's something that the builder would carry. Also, their workman's comps insurance. They're going to be looking at their W-9, the government issued photo ID, and then the VA, like say builder registration. If they're going with a VA loan, like I said, the VA is going to want to make sure that the person is approved by the VA in order to build that home for the active military or the veteran. So this here is a product matrix. It kind of gives you a synopsis of a lot of the information that we had talked about. So you can see with the FHA, it gives you the LTV and the minimum credit score, the eligible terms, and these were all part of the slides that we saw earlier. But 1 unit, site build, modular prefab, manufactured, single, double, wide, ADU, affordable dwelling unit, as permitted by your local zoning authority. So a lot of the construction, as long as it's approved by the county, you're going to be able to get that approved through most of the lending institutions. So optional for initial draw closing, yes, 10% of the cost to build, or $50,000, whichever is less. And then draw paid to builder. Most all the loan programs are going to pay it directly to the builder. That's why they want to do those progress reports, to make sure that the builder is using the money for those draws to do what they say they're going to do as far as building the property. And then it has to be owner occupied. So on the VA, same thing. A lot of the scores they're looking at, minimum credit score is the 620. Remember, though, we'll go down on some of these down to the 580 on that. So you just have to look at the particular program and see if that particular program that they're looking to do will allow them to go down if they have low credit scores. Cindy had mentioned at the beginning that work with people with lower credit scores. Sometimes it's just realigning their credit, and you can get credit scores moved up. And so within a month or two, a lot of times we've been able to get people's credit scores up to put them in a better situation, a better interest rate, more programs that are going to be offered for them. So on the VA is same thing as they're looking at as far as the FHA is concerned. Pretty much if it's permitted by your local zoning authority, they're going to allow it. And yes, 10% or 50,000, whichever less, goes to the builder, and owner occupied only. Now, as you get into the conventional loans, it's more down payments, 5% down, same terms as far as the loan is concerned, but pretty much the same type of properties that they're going to allow. And then the conventional loan, they'll do up to 12% of the cost or 50,000, whichever is less. So you can do a little bit more as far as the upfront is concerned, paid to the builder. They will allow owner occupied and second homes in there. And then the USDA, you're looking at, they can go to the maximum 100 with a 640 credit score, 30 years, basically same type of eligible properties, 10% or 50,000, and the building permit required before closing. So they want to make sure that they've got the permit ready so that they can build on it. There's no issues on that. And then owner occupied on that too. And then, so this is kind of a synopsis, but this gives you a little bit, the type of loan programs, property types that we talked about. Equity contribution, that just means that the borrower can pay additional as far as the equity, but also too, if they already own the land, then depending on how long they own it will determine what's going to be available for them. So if you look at this under the FHA, if the land's value, if owned less than 6 months at the case assignment, the lesser the cost of the land or the appraised site value of the land. So basically, generally speaking, it's going to be the cost of the land. Land value, if owned greater than 6 months at the case assignment, it would be based on the appraised site value of the land. So that would normally give them a little bit more, especially if somebody had land that they had purchased 3, 4, 5 years ago, the value is going up, then this will give them a little bit more equity contribution into the property. The VA, instead of 6 months, they're looking at 12 months. And so that gives you the 12-month time frame as far as whether it's going to be the cost of the land, or you can use the appraised site value of the land if that is actually greater. Conventional, they're looking at the limited cash out refinance, no cash back to the borrower. So you can do, and then the borrower is owner of record of the lot at the same time of the initial loan application. So they're going to give them a little bit more restrictions as far as the conventional is concerned, but the borrower is the owner of the record at the same time of the initial loan application. So they'll give them the flexibility of there's no time frame. So once they purchase the land, they're going to count the value, the site appraised or the appraised site value of the land on that. And then USDA, there's no seasoning, but the borrower must have the owner of record at the time of application. No cash back is allowed in LTV based on the appraised value. So they're going to use the site value, same as the conventional loan there. So it gives them a lot of flexibility. And I think that's the end of it. That's our 1 hour. So remember that a lot of people, we've had a lot of people just in the last year looking, especially when you see the cost of properties that have been skyrocketing, people have been looking at land. I know that, if they go a little bit further out, there's a lot more flexibility as far as the cost on the land is concerned. Like I said, I had one person that was looking at some land down in Farmville, which is, there's a university that's pretty close to there. I think it's called Longwood University, and was able to pick up a lot, a little over 1 acre for like $12,000. And so when you do that, and then adding the property on there, they've got a really nice 3-bedroom, 2-bath house. And, if you're looking at it, for $270,000, nice place. But again, it depends on the property. But just remember, this is just another arrow in your quiver that gives you some flexibility. If you have somebody that says, well, I don't really like what I'm seeing, or it's too expensive, this might be an alternative. And we have done them where people will go out and see the land, buy the land as part of the construction, and be able to close in, like 2.5, 3 months. So it doesn't take them out of the total picture, because once they close on the construction loan, basically you as the realtor are done with it. Then they're dealing with the builder and the lender as far as, the cost and getting things done. Other than that, if anybody had any questions, I can answer those now. I think
Also,
we're pretty
guys,
much-
I will put this recording once it renders this afternoon on Jim's instructor page. And also in the member site. So just keep that in mind that will be there. And I put it there instead of sending links because it protects our copyright.
Okay, and then I can also send the slides out to people that are listed.
Yeah, I sent you the roster, so you can send that out.
Okay,
Cool.
okay. Was everybody on the roster here show up?
I sent it to you. Only one person didn't
Okay.
come. Yeah.
Okay,
Thanks, everybody.
sounds good. You guys take care.
Take care, everybody. Hope you'll all see you in reverse. Take care. Bye.